Welcome to the Sykes Bottom Line Pharmacy Podcast, your regular dose of pharmacy CPA advice, fuel your bottom line, featuring pharmacists, key vendors, and other innovators.
We appreciate everybody joining us for our podcast. We're live on the set today, and our guest is going to be you guys. We want you guys and the audience to facilitate the conversation, ask the questions, and keep it interactive with us. We got a few poll questions we're going to shoot out to you. So we appreciate certainly everybody being here. I'm Scotty Sykes, and I've got Bonnie here with me, and Ken Dale, also with Sykes and Company. And well, let's just go ahead and get into the slides here. Everything here is going to be some technical things we're going to talk about. So talk with your professionals and your advisors before acting on anything or implementing anything here. It's going to depend on your unique situation. So just be aware you need to speak to your own advisors with anything we're talking about here. Quick little blurb about Sykes and Company, our firm. We're a team of about 45 folks, and we work with pharmacies all over the country. And this is pretty much all we do. Eat, sleep, and breathe pharmacy. We're talking to pharmacists every day. And this is the only industry we serve 99%. So this is it for us, and it keeps us certainly busy, and we certainly enjoy working with our clients and with the industry as a whole. So we certainly value that. We have a strong vision to take the best possible care of our staff and our clients, building quality relationships, providing quality services, and so we're very proud of our firm here and our culture and what we strive to do for our team and our clients every day. We do have some pharmacy services in particular. So pharmacy business advisory services, accounting, virtual CFO services, pharmacy tax mitigation and compliance. We're heavy into the tax planning area. Buy-sell transition services, startup. We do some specialized tax credits for pharmacy. And then we have the pharmacy RX assessment service, which we'll touch on towards the end for our self-serving plug there. But that's a one-time service for anybody listening out there. But that could be a good fit for a lot of folks, and we'll touch on more of that in future slides. So again, we want to make this interactive, and we want to hear from you. We want your questions. We want your comments. And we can really steer this thing any way you want. We kind of like to free flow it. That's kind of what we tell all our guests. We kind of just roll with it. So if there's something you want to touch on or ask, send it out there, and we'll try and touch on it tonight. In return, we do ask that we would appreciate if you like, subscribe, did all that social media stuff. I'm not real social media savvy. That'd be Bonnie in this group, but if you'll do all that subscribe stuff, that would be great. Help us out and help us reach more pharmacists out there. Did I say that right, Bonnie? Is it like, subscribe? Is it
like, subscribe,
follow,
comment, follow, share? Yeah,
share,
I think you covered it with all these down here.
Yeah. So I'm glad that you did that, Scotty, because I would have been talking about us for 30 minutes, but that was really quick, so we can jump in there. I'm glad you didn't let me try to sell about us, because we're very proud of what we do here at Sykes.
Yeah, Kendall can get deep on that stuff.
Yeah, he can.
Steven
what
has a
should we
question.
like and subscribe and share to? So we're on the most major platforms to podcast. We record and we release every 2 weeks. So wherever you listen to podcasts, most likely we're there. On Apple devices and most of the major items. It's called the Sykes Bottom Line Pharmacy Podcast. That's the name of it. Great question there. And then on YouTube, like and subscribe and share. There's tons and tons of free content, even on our website, if you go to sykes-cpa.com. And then from there, the media content. See, there I go. So if someone asked me some questions and I started rolling. See, don't keep me
Facebook.
going. And on
Facebook, Twitter,
LinkedIn, all that social media stuff.
But Stephen, if you're looking for the podcast, you can watch those on any of the platforms, and you can also watch, if you want to see the video of us talking, you can watch it on YouTube as well. Same content.
Yeah,
there.
we got a hot following on YouTube. We got a good group of followers on YouTube. So we that's a good spot there. So our agenda tonight is ERC. We're going to touch on the good old ERC. It's Bonnie's favorite.
I might just bow out during that section.
Secure Act 2.0, which was just passed as the recent omnibus bill there at the end of last year. How many $1 trillion was that? Several $1 trillion bill. Anyway, we're going to touch on some quick meal updates that are going to happen in 2023 that you need to be aware of. We're going to touch on accounting methods, inventory updates, and DIR fees. So,
I think we have a poll question, don't we, Scotty?
Do we have a poll question?
Let's do a poll. We want to make sure everybody isn't asleep after all that.
Everybody's paying attention. All right, yeah, let's launch this bad boy. Let's see what we got. What topic are you most interested in tonight?
Yeah, we'll make sure we cover that.
Yeah,
and you can drag these in the order of importance to you. So you can click on one and drag it up to number 1, 2, 3, 4, 5, and we'll be able to get an idea of what people are interested in.
Well, let's see here.
There's those DIR fees rising to the top.
It's like a race. You're seeing like, oh, DIR fees is coming in first. Oh, then there's ERC. Oh. So we're getting, it looks like DIR fee and ERC and accounting methods. Nobody really cares about the meals. Somebody's got some other in there. If you put other, throw it in the chat and we'll try and touch on it if it's something we can cover.
I'm just glad it's the ERC is at first.
So ERC, we'll start with the ERC. That came in second place. Do I close the poll? I'm going to close the poll. DIR fees, ERC, accounting methods. So we'll touch on DIR fees last, kind of save the best for last, but ERC is certainly a hot topic. Matter of fact, we got another ERC poll, don't we? So with the ERC, there are 3 ways to qualify. There's a drop in gross receipts. There's the partial shutdown. There's the full shutdown due to a government order. And I've got some resources on that slide to please refer to. Those notices, you'll see 21-20 and 21-49 is the guidance that is currently out for ERC. It will give you the roadmap of kind of what the IRS is thinking, what they're looking for with these ERC claims. It is not too late to claim the employee retention tax credit. This credit was came out as part of the CARES Act with the pandemic. And originally it didn't get a lot of traction because if you got PPP, you couldn't double dip the wages, or if you got PPP, you couldn't get the ERC. So pretty much probably everybody on here got the PPP. So the ERC wasn't something on anybody's radar until they passed another bill later on towards the end of the 2020, I believe it was. And it made the ERC available even if you got the PPP. So then it kind of came into the picture. And so it's still available. You can still go back and amend payroll tax returns to claim this credit. There's 3 ways to qualify. Like I said, a drop in gross receipts. Kendall, you might want to pull up what that drop is specifically. I believe it's the drop in gross receipts is going to be 50% drop in 2020
Yep, in
versus-
2020 over compared to a quarter in 2019. So basically, before the pandemic hit in 2019, you take that year, you take a quarter, then in 2020, the same quarter. So let's say it's the third quarter for each. And if your gross receipts drop 50%, so your sales, total sales, was half of what you did in the same quarter, basically that's one of the ways that you will qualify in 2020 for the ERC. So that's the kind of, in the 2020, that was the specific guidance.
Yeah.
And then 2021, when you compare a 2021 quarter, so a year later, most companies got a little bit better compared to that same quarter in 2019. It had to be greater than 20% decrease in gross receipts. So it was a little bit easier to qualify, but most businesses started doing a great deal better in 2021. So not all would even qualify in 2021.
Yeah.
And that's just the general guidance on the drop in gross receipts.
And that's no questions asked. If you had that large of a drop in gross receipts, you qualify, period.
It's a black and white test.
Yeah.
And we did have a couple pharmacies that, for whatever reason, there's no reason it had to be towards COVID either.
Right.
So you could have lost a key contract and had nothing to do with COVID. If you had the drop in gross receipts test, if you meet the test, you could qualify. So if you meet that drop in gross receipts test, and every pharmacy, if you had a drop in receipts, I mean, you need to run the test because it's absolutely, you should consider going for the credit.
But a lot of pharmacies, most that we work with, did not see this. Would everyone agree?
No, yeah.
Right.
Most pharmacies did not have the drop. Yeah.
Now, Jonathan has an interesting question. He says, has there been any normalizing for 340B being shut down, which would falsely elevate revenues and offset a drop?
Let me find this question.
It's under the chat. So, yeah, normalizing for 340B being shut down and falsely elevating revenues. So, I'm not sure I understand that question completely. So
it almost sounds like to me you're being a little strategic with how you're recording maybe the 340B. If the 340B stops for a bit.
That's a good question,
it's a
Jonathan.
great
That's a great question. I think that's a great question. I don't have an answer for you here, but it's worth looking into this question. I mean, it's a good question.
That's a great question.
But that's a little more technical, and depending on how you're doing, how you're recording, how you're accounting for 340B can play into this, because 340B is a very tricky animal. It varies depending on contracts and so forth. So great question, but that would be a little more in depth. And if you email us, ask Sykes at Sykes-CPA.com, we'll try and schedule a call with you and help you out there.
Can I answer Rebecca's question?
Yeah, roll with it.
Okay, Rebecca wants to know, why are so many people calling and texting me wanting to help me with this ERTC?
Good question. So Rebecca, so this credit has been a easy, low-hanging fruit for a lot of third parties to come in and say, you qualify. The qualifiers are very broad. You qualify. Let me get you the credit, because the credit is very lucrative. I mean, it is a significant credit. And like if you're a regular, normal, average pharmacy, you could be looking at least $50,000 of tax credit. So it's a lucrative credit. And so these companies they're going to charge 20% of the credit amount. There's no, they don't need to be qualified in anything. So they can just open up a, ERC credit LLC, John Smith off the street, and say, all right, you qualify. Let me get you the credit. I'll amend the tax return, payroll tax returns, get you your credit monies, and I'm going to take 20% of it. So it's a very lucrative
So that's the answer. They want the money, Rebecca.
And so that's why you're seeing so much heat out there on this. And the IRS, and my resource there, the IRS has issued a news release to be aware of these third parties promoting improper claims. So you just want to be aware and do your due diligence. But moving forward here, I think dropping gross receipts is pretty cut and dry. The full shutdown did not happen for pharmacies, so we won't talk about that. The partial shutdown is really what these third parties are going to go for. And, you know, we're not going to sit here and tell you don't qualify, but you definitely need to be prepared to do your due diligence with a partial shutdown. Those 2 notices I've linked in here, those resources will help you with that. But it is it's pretty in-depth process that you have to prove that you've qualified. You have to prove a more than nominal impact to your pharmacy. It's a quantitative number of 10%. How do you prove that? It's pretty in depth. So just be aware and that it's a very in depth process, and you need to do your due diligence.
Yeah.
And the point that I think everyone needs to understand too is, and I think we've said this on the podcast before, but just to reiterate, you're the one that's signing that. So this third party that comes and helps you do it, they're not tied to that at all. You are saying that this is accurate information, even if you don't read it. It's a lot that you sign and send in. And so if you're ever audited a few years from now, and that's going to happen with a lot of pharmacies and lots of businesses, that third party is probably not going to be there to help you with that when that time comes. So just keep that in mind. You need to truly understand it, like Scotty mentioned. Understand what you're putting out there.
And we got some. Sorry, Kendall. We got some deeper content on the partial shutdown. So if you go search our podcast, I think we got the podcast episode on it actually.
Yeah, we got a full
that partial
episode.
Yeah,
we got 3 episodes on the ERC. So if you go to look at the Sykes Bottom Line podcast, and as different updates came out, we've kind of released them, and I think the whole partial shutdown and full shutdown, a lot of places closed their doors or maybe did curbside, and for pharmacies, a lot of that was elective. They wanted to protect their staff and things like that. But for most times when I looked, it was not a government order for pharmacies to shut down. So that's something else you got to think about. Just because you shut down, was it due to government order? So, right.
And the supplier, I had a supplier. Well, if you look at the regulations, it's going to say who was, what was the drug or drugs? Could you source them elsewhere? What government order was the supplier under that caused them to, you have a supply issue? Were there alternative options? It's very in depth. It's not just saying I had a supply concern.
Right.
And they do want the government order the supplier was under that caused the disruption to your business. So it's just an example kind of how involved this is. It's not just, hey, you had a supply problem. So.
And Fran had a good question. She's asking, what if you sold a store during the year, like maybe one of your 2 stores, and so obviously you had a drop in sales? Fran, what we have understood in the rules is that you would annualize your income. And so you would look at things like that and take that into account when you're looking at a certain period of time.
So I'm kind of surprised. We have 50% say no, they haven't been contacted by the ERC third party. 45% said yes. 5% said leave me alone. So,
I know that I have clients that almost every day that email me to say they've been contacted. So they're out harassed. It's getting to the point of harassment. So just.
And there was a lot of other programs out there that are no longer available, if you think about the PPP and other things. So now a lot of those third parties are really focusing in on this one because it's like the last thing out there that they can try to get a percentage out there.
Steven says, I typically hang up on people who tell me they can, wait, what was that? It just cut out on me.
That tell him that they can make him money. That's a really smart. They're getting a piece of it.
Yeah, they sure are. But if you do have questions on ERC, Bonnie Bond right here will be your go-to. She loves the ERC.
No,
She's the expert.
that's not true.
All right,
On to the
Secure
next
Act.
topic.
So this is a monster of a change for the retirement side for really across the board. So this is the Secure Act 2.0. 1.0 was, well, I think it was 2019, if I'm not mistaken, the first part. So the second part was passed as part of that omnibus bill there at the end of last year. Some notable provisions effective 1/1/2023. They've raised the age to require minimum distributions to 73. So anyone out there, older individuals that are going to be looking at taking RMDs, there's been some changes to that. They've upped that age, and I think they up it again down the road as well.
In 2023, like, and then 75, 2033.
Yeah, yep. It extends an existing tax credit for startup plans. So if you don't have a retirement plan in place in your pharmacy, they've extended that credit or expanded it, I should say. So it's a 3-year credit increase to 100% of the plan cost, administration costs for companies with 50 or fewer employees, capped at $5,000 per employee. And then there's an additional credit to that, offsetting up to $1,000 of contributions per employee in the first year, phased down over 5 years. So, if you don't have any retirement plans in your pharmacy, be aware that starting this year, there's going to be some changes there and some expanded tax credits that you'll definitely want to take advantage of when looking at retirement plans in your pharmacy. And as we look at retirement plans in your pharmacy, generally speaking, the rule of thumb there is going to be the typical 401k plan with a safe harbor profit sharing component to it. Simple plans are not simple. We don't normally want to see a simple plan. They have some limitations, although those limitations have changed now with the Secure Act 2.0. But that 401k is generally the rule of thumb there. One big one that I like is the company match allowed can now go towards regular 401k or the Roth 401k. So if anybody out there now has been getting a company match, it's been going to a regular 401k account, but now that can be going into a Roth account, which when a Roth is after tax, so you're paying tax up front right there, but later on down the road, the tax already been paid. There's no tax upon the distributions, generally speaking there. So I really like that component. I love the Roth option. Roth IRAs, Roth 401ks are great vehicles, but certainly speak with your advisors on what's the best way for you there. But that's kind of the highlights for 2023. And starting in 2024, this thing is it's going to kick up another 10 levels because the changes for 2024 and 2025 are exponential. What's going to be coming down the pipe. So we'll have those updates as we get into that.
And one thing just on bullet point number 2, talk about for employers with 51 to 100 employees, there's still a credit. So that's a dollar for dollar credit. So for every dollar you get that credit for the cost of setting it up, it's just going to be 50% of the cost. But you're still something to look at if you don't have a retirement plan.
All right, meals.
This one's a bummer.
Bonnie, you just ate dinner before we got on here, so why don't you cover meals here?
Well, obviously,
you
internally,
got a little,
fish taco.
Yeah.
Thanks for calling me out. Business meals, obviously, internally were a whole lot easier to account for, guys, in 2022 when it was 100% deductible. So that was a lot easier on us for sure and our staff. So business meals are generally going to be 50% deductible. moving forward in 2023. If you can prove a business connection. And obviously, we have it mentioned here. They need to be necessary. There needs to be a business connection. You got to watch the lavish or extravagantness of your specific meal. Got to be able to document it, have that in place.
So the documentation will look like essentially a copy of the receipt and then a quick note on who was there and what was the purpose of the meal.
And I love number 5 that, someone probably from that organization should be present.
Yeah.
Yes.
But we get a lot of stuff, so we want to make sure everybody realizes that. But the big change here is the, it's gone from 100% from last year to 50%. So just keep that in mind as you think about these things.
That was a part of that restaurant. If you got it from a restaurant, it was 100% trying to keep the restaurants going on.
And entertainment is always, a hard thing for everyone to kind of understand. They're non-deductible, even if it's a business connection. So you're talking about things like take the food out of it. If you're going to a concert or a ball game, tickets and things like that, it's unfortunately not going to work.
But there are some exceptions.
There are some exceptions.
So be aware of that.
Yes. And the business gifts, we always get that a lot. So, if you're doing it correctly, we have clients ask all the time, hey, I want to give all my employees a $50 gift card for Christmas or something. Well, it's genuinely limited to $25 per recipient. So keep that in mind. Really, that's all you can really do as far as a gift without technically supposed to be adding that back to their W-2.
Yep. Big thing here is, documentation, because if you ever get an audit, they're going to ask for your depreciation schedule showing your assets. If you got vehicles, they want to see the vehicle logs. They want to see if you got a bunch of meals. I've seen an audit where there's been a whole lot of meals and they want to see that substantiation, that documentation. And if you have this documentation in file and and the auditor comes in and sees that you have this documentation, you're probably going to have hopefully a smooth audit experience. But if you don't have it, the auditor is going to dig in and they're going to start having some fun. So, and yes, that is per year.
Per year.
For the business. Yeah,
it's not very much. But that's the whole point of the IRS wants you to pay people through a W-2.
Yeah, it's the same as a bonus for Steven.
Yeah.
That's the same as, so if it's a gift and it's included in their W-2 wages, so meaning they pay tax on it, then that gift is basically a bonus because they're paying tax. And then the bonus is, for example, I got some ball tickets a couple of times from somewhere I worked and they did have the amount listed and I did pay tax on it. So, that can be over $25.
Yeah, you can give someone a $500 gift card if you want to, but then you need to report it and have it added back. It's a pain, but that's the rule.
It is a pain. Counting methods. So we went to CARE conference this past weekend, and we actually had a lot of folks still inquiring about the accounting methods. So part of the Tax Cuts and Jobs Act of 2017, we had, the law allowed pharmacies to report for tax purposes on the cash method. Generally speaking, before that change in the law, pharmacies had to report taxes on the accrual method. So that opened the door for some big tax planning opportunities for pharmacies at that time, because when you move from an accrual basis of accounting to cash basis of accounting, you're essentially, when you think about it, an accrual accounting system is going to record revenue when you adjudicate the script, and expenses are recorded when incurred. So you're going to have a lot of third-party receivables if you're a retail pharmacy sitting on the books for the accrual method, because you have to record that income when adjudicated, even though you haven't actually collected it yet. And the cash method, on the other hand, is going to record cash when you've actually received it in the bank account. On the expense side, it's going to be when you actually paid it. So when we go from an accrual method to a cash method, you're essentially writing off. You're adjusting those accounts, but you're right. The big piece of the puzzle here is going to be those receivables. You're going to be writing those off, and generally when you do that, when you write off receivables, that lowers your revenue, and ultimately that lowers your bottom line. So it was a huge tax savings tool for a lot of pharmacies out there for tax year 2017, 18. But we're still seeing some pharmacies inquire about this. We're still seeing pharmacies not taking advantage of it when we have pharmacies come do the RX assessment service with us. So just be aware that pharmacies can consider using the cash method if you're eligible. Now, if you're eligible, the eligibility is there's a gross receipts test, and you have to have less than prior 3-year average gross receipts of, I think it's $29 million for the current year. So if your average gross receipts for the prior 3 years is less than $29 million, you could be eligible for the cash method. There's a couple other outliers, instances where you might not be eligible, but generally you're going to be eligible there. And so with the average pharmacy at $4 million revenue, the cash method is on the table for a lot of you guys out there. And it's the average prior 3 years. So you take each year, add them up, divide by 3. If you're less than the 29, cash method is on the table perhaps for you. And when you make that switch, like I said, you're writing off those receivables. You're also writing off you're adjusting payables and things like that. But the big chunk right here is going to be those receivables, and that usually will reduce the bottom line, giving you some valuable tax savings. Again, we're still seeing pharmacies not taking advantage of this for whatever reason. So just be aware that this is still out there, and it's still on the table. What I missed, guys?
I want to touch on inventory. We had some people start that same year, Scotty, where they also wrote off inventory. That's got to come back.
Yeah, inventory is a whole nother animal. So let me get a sip of water for this one. So when the Tax Cuts and Jobs Act came out, I think I got a slide. Yeah, I got a slide.
Hey, do you?
I do.
Well, look at that.
They allowed inventory has its own rules. So under the cash method, there's 3 ways you can treat inventory. Conform to the method used in your applicable financial statement. That's the AFS method, which that method is, we're not going to talk about it because it's generally audited financial statements. It's financials that are for the SEC or a government agency. So that's really not on the table for pharmacies. The second way was to treat inventory as non-incidental materials and supplies. And then the third way was to conform, option was to conform your inventory method to the way you handle your books and records, prepared in accordance with your accounting procedures. So starting with number 2 there, what you saw in the industry back in 2018 with the Tax Cuts and Jobs Act was a lot of promoters out there saying, well, we're going to elect our inventory to be non-incidental materials and supplies, and we are going to make an election. There's an election in tax law that's called the de minimis election that allows you to write off non-incidental materials and supplies that are under $2,500 per item. And what promoters were doing, we're saying we're gonna treat inventory as those non-incidental materials and supplies. We're gonna make that election, and we're gonna write off inventory. Well, the IRS in Treasury Decision 9942 got a resource link there. Came out in January of 2021 and said, hold the phone. That's not going to fly. They essentially said inventory that's treated as non-incidental materials and supplies is still going to be inventory, and inventory is not eligible for the de minimis election. So they kicked that out. And so if you're a pharmacy owner that wrote off inventories, elected to, well, first you treated non-incidental materials and supplies for your inventory, made the election, wrote off inventory on your tax return, you need to go back and look at 9942, Treasury Decision 9942, and you need to be prepared to pick that back up on the tax return. And when you do that, you are going to have to do a change in accounting method. There's a form 3115 you'll have to do. And essentially, when you bring inventory back on the books, because when you wrote it off is an expense, you wrote it off through cost of goods. When you bring it back on the books, though, for tax return, it's going to be income.
Yeah.
Now, this is where the IRS is actually nice, because they say, we'll let you spread that out, that income out over up to 4 years. So that was a nice little gift from the IRS. But that Treasury Decision 9942, nobody has been talking about this. And we know a lot of pharmacies wrote off inventory. I mean, we've seen it. We've seen the ARC's assessments. So be aware, this is a new big change. I
have a bad feeling there's a lot of people that don't.
Matter of fact, do I have a poll question on this? I think I do. And just moving on, the inventory method for your books and records, we've also had some pharmacies, I think, use that method to write off inventory. And the IRS is also in that Treasury Decision 9942 guidance has said, if you do anything with keeping inventory, you have to book inventory for taxes. So if you're using a perpetual system, if you have a count, if you're doing cycle counts, if you're doing anything to track any kind of inventory, which all pharmacies are doing, you gotta put it on the tax return. So again, point you to that 9942. And I've got some other resources there on the cash method of accounting. So let's see. What did I miss? Did I miss anything?
I got it.
I think we covered that.
Mm-hmm.
Let's see if we can get a quick read on who's switched accounting methods, cash basis for tax purposes. If you'll please respond. And results are coming in.
I love that there are people with who the heck knows.
23% has
I
no
like
clue.
that though. You know, if I didn't do accounting or tax, I wouldn't want to know either. I'd just be like, handle it, please. Just take care of it.
Well, our little motto here is, we don't fill scripts, we'd kill somebody, and we don't expect you to handle the back office either. So
no way.
And on that accrual of cash, I mean, I think we definitely, I think one thing to emphasize is just it's extremely big for pharmacies, because compared to other industries, the receivable balance in the pharmacy is so big that if it's something you haven't taken advantage of, the tax savings can be significant if you're a good candidate. There's a lot of different things you got to look at, but it's something that if you don't know, it's worth investigating before the year's over with.
Yeah, you do have, if you haven't done it and it makes sense to do it in your, it's not an automatic. You have to do the planning to make sure it's something that makes sense for you.
Right.
And it makes sense. You could make that switch here for 2022 with the filing of your 2022 tax return here. So most people said yes, they have. We've got 29% said no, and 17% said who the heck knows.
Got a nice question.
What question do we have today?
So is it really moving it to 1 year versus an annual write-off for the non-payment?
So it is when you make the change in accounting method for tax purposes, it is a one-time thing. Each year thereafter, you're not going to get that benefit again and again. However, when you are a cash basis taxpayer, you can control your bottom line a little. You have a lot more flexibility there, right?
Yeah.
You can prepay.
Mm-hmm.
We've got a bunch of clients that have prepaid rent or advertising.
For the
You
year.
can do a lot of things to go ahead and write off something before the end of the year to get that expense in that current tax year. So you have a lot of flexibility that you otherwise would not have with the cash method as well.
I can't help but mention too, we say this a lot. Even though you can do this, Kendall, Scotty, the accrual to cash for tax purposes, you want to make sure, especially as a pharmacy, that you're keeping your books and records throughout the year in accrual basis, so that you're not going to be able to understand how your pharmacy is operating if you keep your books on cash basis throughout the year.
Yeah.
You still got to be making the adjustments for your third party. That drives everything on your balance sheet and your P&L and inventory. So just keep that in mind. So we keep basically 2 sets of books for our clients so that we can, for tax purposes, and the other to actually see how the pharmacies operate during the year. You have to do it.
Well, it's one set of books, but it's journal entries.
General adjustments, yeah.
There are some complexities related to doing that on an accounting standpoint, but the benefits
yes
are definitely there. So
all right, did we get all the questions? All right, I think we did. All right, we're going to go to DIR. Here we go. DIR. Boy, this is a hot one.
Look at those percentages.
Yeah, they're going up. Let me launch my poll here. Let's see if I find my poll. Okay. So DIR, we're seeing, well, as you can see, the trends are going up. 2.5% in 2020, 21 was 3.5%, 2022, 4.5%, maybe even 5%. These are just approximate averages based on our data. And so you have to assume 5.5% for 2023. I mean, that's only fair assumption there. So starting in 2024, as we all know, as most of you know, I'm sure, DIR is going to be at the lowest net price is going to happen at the point of sale. So that'll be on 1/1/2024. And so there will be no, technically there's going to not be any retroactive DIR fee. It's going to be right there at the point of sale. So that means in the first month or two, first quarter of 2024, you're going to have the lowest net price at the point of sale, but you're also going to have that 2023 retroactive DIR fee hitting in 2024 as well. So it's going to put a strain on some cash flow. How bad is it going to be? Don't know. It's unknown what it's going to look like and how it's going to impact the pharmacies. But it is going to impact the pharmacy. And so that's kind of what's around the corner for these DIRs. So, what can pharmacies do to prepare here? And we launched our poll. Let's see, we got most are recording in the accounting system, 58%. 25% say no, 13% say I don't know how to do that. 4% said what's a DIR fee. I actually mentioned what's a DIR fee because I've been with some compounders.
Yeah.
And the person literally raised her hand and said, "What's a DIR fee?" She had absolutely she had no clue what a DIR fee was.
Oh wow.
Yeah. So anyway, so you need to be getting those in your accounting system for sure. Those third-party reconciliation systems, which you have to have, you need to have. If you don't have one, you need to manage it. You need to have a process and procedure in place to keep it up to date on a daily, weekly basis. You need to make those adjustments in your accounting system on a monthly basis. You need to utilize that data to pull those DIR fees, gross up revenues, expense it out on your books and records, so you can then start to track what percentages am I, how am I doing compared to those trends we just saw? Am I below average? Am I above average? And then you can open up a whole new set of questions on how to better manage your situation. I'm below average, or if you're above average, you can say, all right, well, why am I above average? What am I doing? What can I do? You can start to just dig into it. And the pharmacies that are below average, I'll tell you one thing. We're going to touch on this. They are engaged with their DIR fees.
Yeah.
They know the contracts, they've got the estimates in there, so on and so forth. So they're engaged in their DIR fees. But if you don't know kind of where your DIR fees are, that's step one. Get them in the accounting system. And we get a lot of, there's always going to be someone that's going to kind of push back and say, well, I don't think they should be an expense. They should be a offset revenue or be a cost of goods or whatever. It doesn't matter where you put this DIR fee expense or whatever you want to call it into your accounting system. The point is you want to get it in there so you can track it.
Yeah.
So,
and that's what Amanda's sort of asking for the entry. Do they need to be by payer or simply a DIR fee expense account? We use a DIR fee expense account. We like to do it that way because we can see the percentage and follow and compare percentages amongst our clients and in the industry. So we can see that percentage of sales. So we can see it's 4%, 5%, or this person's is 8%. You can really be able to see it. It's the point of breaking it out.
Yeah.
Kathy has an interesting question. She wants to know, how do you not know what a DIR fee is in pharmacy? I think you said you were with a compounder. That
I
might
was
have
with
been
the cash. I was with the cash compounder.
cash only.
Yeah.
That's why they don't know.
Let's see. So yeah, so get those into your system for sure. Very important. And I think we kind of have like a speaking internally here and with our resources, we've kind of put together a 4-point plan for DIR fees 2023, 2024. And the rubber really meets the road here, I think, in 2023. And that's going to start with the fundamental accounting. And we will do that. But yes, it starts with the fundamental accounting. Your accounting is going to be the direction. It's going to show you the direction of your pharmacy and what you need to be doing to prepare for a cash flow impact. Your accounting is going to open the door on you have concerns or issues here or here or here, and that's going to allow you in 2023 to then address those concerns, address those issues, and get yourself in a position where you'll be better prepared for 2024. Your accounting here is an asset, and you have to use it as an asset in your pharmacy. We're accountants, obviously, but fundamental accounting is critical in all businesses, but especially pharmacy, because you have you already have thin margin. You've got tight costs. You got to be on top of your numbers to know what's going on because you have very little margin for error. So utilize your fundamental accounting, get it up to speed, do the ARCS assessment service if you're not sure, which we're going to have a quick slide at the end. If you're not sure where you are or what you need to work on, take advantage of the service we do. It's a one-time service where we spend about an hour and a half with you going through your accounting and tax situation and give you a roadmap of the things you need to do. So fundamental accounting is huge. You're going to have to use this as a tool for you. Revenue and expenses. So then once you have those fundamentals in place, hey, maybe it's a margin issue. Maybe my margin's not where it needs to be. Maybe my expenses are out of whack. This it's going to put together the whole cash flow picture of your pharmacy. And so you'll be able to understand cash flow. Is it my debt service? Is it my inventory? My receivables tied up somewhere? Am I drawing too much money out of the pharmacy? Is it payroll expense? Are my DRs just extraordinarily high compared to normal? So it starts opening up all these questions. And the revenue side is something that's also, I think, important to talk about here because COVID brought to the table pharmacies doing a lot more other services beyond just filling scripts, the point of care testing, the vaccinations, the supplements, the functional medicine, the clinical services, so on and so forth. So I think pharmacies you need to really consider how you can get some cash base, other revenue coming into the pharmacy. So you're just not relying 100% on those PBMs, and where you can grow that and make it a significant portion of your business and grow that margin. Expenses obviously are a key area. DIR fees are the number 3 expense now in a pharmacy behind wages and cost of goods. Wages, we have pharmacies that are extremely efficient using technology. Their wages are, 6, 7, 8% of revenue in their pharmacies, which is extremely lean. So their bottom lines are very flush in terms of profitability and cash flow, obviously. So those two components I think are huge, and the revenues is something you just got to start really growing into in your pharmacy, finding that area in your community that works, that you can fill.
Yep.
And I tell you, the chat has been going on pretty hot while you went through that, Scotty. It was a great overview. One thing was mentioned is about breaking down DIR fees by payer. Yeah, that's something that you can analyze based on the reports from the third-party reconciliation service. And I think that kind of, when we talk about being engaged, it's looking at those reports, looking at it by payer, looking at it by script. I know some people who will start turning away scripts that they found out they were losing money on after DIR fees.
And somebody mentioned that in the chat earlier. It was really great. I think it was Austin, what he was doing. He has it broken down by payer. To help analyze which plans are most negatively impacting the pharmacy and honing in on strategies to mitigate those specific losses. So that's what we're talking about. I mean, the people that are keeping these DIR fees down as much as they can is they're doing these kind of things, like Austin mentioned, like really digging down deep and figuring out what's causing the higher amounts.
Especially on certain scripts, like specialty scripts and things like that. Unfortunately, if they're losing a lot of money on the script, they have to just help them find another place to fill those scripts in some situations. So it's a very proactive mindset that you have to have, not a fill and pray type approach. And
that PSAO is a key part to that. So working with your PSAO, having that relationship with them, having those contracts up to date in your point of sale system, so you can, like you said, Kendall, you can see the DIR fee estimate added time of adjudication. And we've had a lot of pharmacies that have started to implement that, and they're seeing that they thought they were making $1,000, they're actually losing $300. So, it's absolutely terrible, but there's pharmacies out there that are just saying, I'm not filling this brand anymore. I can't service you anymore. I'm losing $300. And we do have pharmacies that will set a threshold. If I'm losing $50 or $100, I can offset it with this or that. But, this is the unfortunate reality that you might have to turn down some patients. Let's see. Are we caught up on questions? If you track DIR fees,
they're rolling in now, Scotty.
Yeah, if you track
we
DIR
might have
fees,
to direct some of them to Sykes.com.
I mean, yeah.
Ask Sykes.
We had a question about payroll percentages. We're still seeing that in about the 10% range, right, guys?
For retail, about 10% is going to be your golden number there. If you're in the single digits, you are probably going to have a nice bottom line and good cash flow. So technology, anything you can do, looking at your hours, looking at the time you're open, is going to be important. 10% includes owner.
It does in most situations, but.
And we've talked about the mindset, number 4. You got to have the mindset. It's just the way it is. When we're facing challenges, you got to have that mindset. And the pharmacies that are excelling have the mindset. I can tell you that. All right.
Got a couple more minutes. We're wrapping this thing up. I'll tell you one thing, that chat got on fire once we started talking
And
about
we're going to have
DIR
some more
fees.
DRP content. We're going to have more into that. So keep in tune with the podcast and any articles or anything else we're going to push out on that. So we'll have some more content on DR fees coming out. So we already plugged the ARCS assessment. Again, if you want to start and figure out, how do I get these fundamentals in place so I can really take control of my cash flow situation, this is going to be it. The ARCS assessment, third-party overview of your current accounting and tax situation from our team of pharmacy accountants and CPA advisors. We spend about an hour and a half with you on the phone, on a video call like we're doing here today, with your information on the screen there. We'll give you some actionable items and a roadmap of the things we think you need to do. Again, this is a great step for those out there that are looking to plan and prepare for these DR fee changes. This is a one-time service, so there's no further obligation with our firm or anything like that. Just a one-time thing. We have pharmacies that come to us and just do the RX assessment once a year. So that's perfectly fine.
Yeah.
We do charge $1,995 for that service. And there is the link for that service. If you go to our homepage, Sykes-CPA.com, it'll be at the very top, RX assessment link.
And I'll just say, All in Sykes looks at the books, gets into the actual accounting file, and we look at hundreds, All looks at thousands of pharmacies. So with that information that you get with that service, it can sometimes completely change your pharmacy around. You can take decisions and just go with it, or the tax savings sometimes with things that's identified that's missed. It's kind of one of those things that if you got a gut feeling something's not right, it's kind of a no-brainer just to get someone to take a look at it and see.
It really is a checkup.
Something
like
you
going
need
to the doctor. Yeah.
Look at a little further. Yeah.
So we appreciate everybody listening in. We certainly, if you got any other questions or anything else you want to ask us, shoot us an email, ask@sykes-cpa.com. Any future content you want to hear from us, we'll be glad to cover that as best we can. But we appreciate everybody listening in here tonight, and hope everybody has a pleasant evening, and we'll see you guys in the near future.
Yes, you can call me, because we the best, Sykes and Company. We the best, Sykes and Company. Your accounting is a mess, there's no need for you to stress.